that's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you kind of what I mean by that too. The big traders, who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there, and I think that's what we're seeing right now. Go ahead, be stupid enough to knock it down. We'll stand for delivery, and if you're not going to deliver to us, we'll incentivize you through massive arbitrage by having a price that is much higher than it is in the West, so you'll think twice when you can deliver me 50 million ounces of silver at a huge VIG and then go buy yourself, I guess it's just a frosting on top of the BU or the uncirculated, the BU coins that we sell, the commercial strike, I guess just don't have this frosting, which is nearly impossible to discern between the two. In essence, it's lipstick on a pig, and there's no reason to buy the uncirculated coin from the U.S. Mint because the brilliant uncirculated coins, uncirculated being the U in BU, that you're getting from any dealer like myself, is just a better value. I guess if you're collecting it as part of a set, where you're collecting the proof and the uncirculated coin as issued by the mint, one set or whatever each year, fine. But again, anything that you're buying from the mint is not really economical from the standpoint of building your core position. It's more along the lines of things that you want to collect, and most of those things won't return their value. Some of them will, I guess. Some of them are made in very small quantities, and maybe they will, but certainly that's kind of the sprinkles and the hot fudge on top of the vanilla ice cream, which would be just the normal commercial strike, where you're getting more content rather than frosting, so to speak.
Behind the scenes, a different kind of buying is underway, one rooted in physical ownership rather than paper positions. Industry veterans report record volumes of physical silver being taken delivery from major exchanges, suggesting that strong hands, institutions, and sovereign buyers are accumulating real metal instead of futures contracts. This shift highlights a growing skepticism towards synthetic holdings and a preference for tangible assets, particularly as confidence in paper markets wavers. The supply-demand tug is becoming a defining feature of silver's trajectory.
I'm just looking to see what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up 110 bucks. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, that's over 30% right back. I think what people need to understand is, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first, because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. Becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. But this is also true of speculators. And the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin, and that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage. And they force the weak hands out. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented like we saw, and futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market, that's the shakeout. That's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you a kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic, and they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price.
Silver's price behavior over recent years has involved repeated downward pressure from futures markets and alleged manipulation tactics. Analysts argue that these moves are not always reflective of genuine market conditions, but instead designed to influence settlement prices and trading psychology. At the same time, physical premiums and delivery stresses suggest that the narrative on the ground differs from what futures prices alone convey. This divergence between paper markets and physical reality is prompting questions about the integrity of traditional pricing mechanisms and whether they can persist under mounting demand.
You had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF. This tells you that someone with a real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults, because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem.
Unlike gold, which is traditionally viewed as purely a monetary metal, silver's role in modern technology and industry adds complexity to its market dynamics. Its unparalleled conductivity makes it indispensable in electronics, solar panels, and advanced manufacturing. At the same time, recent government designations of silver as a critical mineral underscore its strategic importance. This convergence of industrial demand, strategic stockpiling, and investor accumulation creates a unique pressure on supply, one that cannot be dismissed as mere speculation.
If I had to guess, now I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs. If I had to guess. Now, what do I know? But based upon what I see, the 30+% swing back today, boom, no, why aren't people freaking out when it goes back up 30%? Yeah, we'll get back up there, and I think it'll be buyer before March. If I had to guess, And all that happened is that the metal went from weak speculative hands who were holding lots of leverage to the big money that says, thank you so much for that discount. By the way, I won't be standing for any margin. I'm just going to pay cash for it. And if you look, who covered almost 700 contracts at 5,000 ounces apiece at the very, very bottom? Oh, that's right. It was J.P. Morgan. How foolish of me to think otherwise. You get it? The big money is still in control, but they are showing you where this is going. Not ending the bull market, just kind of showing the big traders who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there, and I think that's what we're seeing right now.
The behavior of global central banks provides another layer of context. Many central banks have increased their gold holdings, signaling a broader reassessment of fiat currency reliability, particularly the US dollar as a reserve asset. As currency confidence fluctuates amid inflation and fiscal challenges, precious metals increasingly serve as safe havens. Silver, with its dual industrial and monetary uses, occupies a distinctive position in this shift, attracting both strategic reserves and investor interest, especially as traditional financial instruments face headwinds.
Where, it's about protect your home first. I think that's what this is all about to a degree. Globalism isn't working for us so well. And I think that's why you're seeing the rise of all of these exchanges and the idea of what the BRICS are talking about. And for people who poo-poo the BRICS, I'm tired of it. In fact, I talked about it at that Vancouver Resource Investment Conference, and I had Nomi Prince backstage saying, you're right. And she's one smart lady, and she said it right there on stage with me too, and that is that all of these countries are using their local currencies over things like Enbridge or the CIPS, the cross bank, or what is it, the cross interbank payment system, something like that. Both of these things, both of these platforms are free from SWIFT intervention. And when you get institutions or entities like the Asian countries, the ASEAN, the acronym, those countries in Southeast Asia that have 800 million people, that have twice the population of the U.S., that are China's largest trading partner by far, 30+% of global GDP using these systems, well, you're no longer settling in dollars if you're using these systems by a massive entity of people. And then at the same time, and maybe they are some dollar settlement, but a lot of it is now going elsewhere. And which begs to the bigger question. When you have all of these transactions being done in dollars, you have reserves. Those reserves are then usually put into treasuries to make interest on those reserves with safety and liquidity. But now they're not doing that because they don't have the reserves. They're using other currencies. So they're not buying bonds, and instead, what are they all settling imbalances in throughout the BRICS and this expansion of all these vaults? Gold. And that is the whole premise of their new payment system, is to trade local currencies over Enbridge or CIPS or any of the other payment systems that they've all designed that are free from SWIFT intervention, and settle imbalances, whether it be currency or trade, in gold through a set of multi-jurisdictional vaults. Moscow, Shanghai, Singapore, Dubai, all of them at the BRICS vaults, and all of those that will be built, the one that was just built in Hong Kong and now the one being built in Saudi Arabia, well, they're all for the same game. Trade your own currencies, defend your own ecosystem, build your own monetary future from within instead of strengthening that of the United States, settle imbalances in gold instead of treasuries. The settling outside of dollars chips away at the dollar settlement status, makes the dollar fall, and the lack of purchases of treasuries, well, chips away at the reserve status. So this is a slow, little by little process. But I do think that is exactly what is happening, is that you will see a world that embraces gold as a settlement vehicle. And at some point, real price will matter. And if you're trying to accumulate it, you just play the game of the West. Go ahead, be stupid enough to knock it down. We'll stand for delivery. And if you're not going to deliver to us, we'll incentivize you through massive arbitrage by having a price that is much higher than it is in the West. So you'll think twice when you can deliver me 50 million ounces of silver at a huge vig, and then go buy yourself, a couple of yachts and live in Tahiti forever, because that arbitrage is significant and it's unrelenting. They're not letting it go away.
Looking ahead, the silver market stands at a crossroads. If physical demand continues to outpace available supply, juxtaposed with the complexities of the paper futures framework, systemic stress could intensify. Some analysts argue that markets may reach breaking points where shortages surface more tangibly and price structures adjust rapidly. For investors, this isn't merely about short-term gains. It's a strategic debate about wealth preservation in a world where confidence in fiat systems is weakening and tangible assets are increasingly prized.
And then you get some of the people who find it appropriate to say, well, the price is down, can I get a new price? Which really irks me, because we hedge everything. And people don't understand the risk that goes into locking in an order on someone's verbal handshake. And the price goes down and you have it hedged. If you don't hedge your metal, this is the whole idea of what we're talking about here with the hedging, then you are dead, right? If you have 5 million ounces of silver that was worth, what was that worth? $500 million, is that right? Was that right? Yeah, that would be right. When it was $100 an ounce. If you have 500 million ounces of silver and you're hedging it and the price goes down by $10, how dead are you? And you're never going to get that money back. So you have to hedge it. So one goes up, one goes down, commensurate. And we would normally have 2-3 million ounces of silver in the warehouse. And hedging it, if the price of 2 million ounces and the price fell by $50 or $40, do you see the math? That's $80 million. You're done. You're out of business. You're never going to work again. We live in a world of immediacy, where everything is at the touch of your, tip of your fingers, and you get it immediate. Instant gratification is not quick enough, and it's important to understand with physical metal that there is a certain level of logistics involved with it, which is becoming kind of log jammed right now. It's the exception. It's not the rule. But this market has, this industry over the last 5 years, since I've known you, Dunnigan, it really has a habit of going from 0 to 100 and then back to 20 and then back to 150 and then back to, there's these moments of craziness coupled with moments of, boredom, quiet. Maybe I'll play golf today instead of coming into the office kind of thing. It's been more of the former rather than the latter lately, but I think it's wise advice to prepare when you don't need to prepare, and so you don't have to worry about it and scramble at the 12th hour. Very, very, very good advice.